Welcome, everyone. In 60 minutes, the US stock market will open, and this moment is for us here to determine which stock to trade now. Disclaimer, not a licensed financial advisor. This is just information, educational resources to help you do your own due diligence. But that being said, I think in this next little bit of time, we should be determining whether or not you should be buying any stocks, any US stocks. If you're interested in buying any US stocks, I'm going to try to make a case why today is not a good day to buy them, unless you're going to buy one of those ETFs that benefits from going down. Because I think that's what's going to happen, is that we're going to see stocks go down today. We lay out the reasons why and show you a couple of the good ETFs that might be worth considering. John, you're here. Awesome. Paresh, you're here. You guys. So I did a class, a workshop over the week, and I had laid out my opinions there of why I think the markets are going to go down today. And the biggest reason is that we're at the end of the third quarter. We're approaching the end, but hedge funds and institutional funds, they want to sort of close off their quarter because, they get measured quarter by quarter. They want to close off their quarter with gains, which means that they want to lock in their profits. Now, it could be that more profits are coming in the fourth quarter, and they know that. If they thought that they had a good indication that profits, the stocks were going to continue to go higher through the next quarter, they wouldn't want to sell. But if somehow they believe that whatever is coming in the next quarter is going to be a little scary, a little slow moving, and they need to be use all next quarter sort of adjust for next year, because we've had a great year so far, they might say, let's take some off the table. And if they were going to do that, not all of them, but those of them, and I think this is the majority, those of them that have to have the trade settled before the end of the quarter, those ones have to make their trades today, which means that we could see some amount of selling. And the more selling we see, the more these large institutional funds are telegraphing that they are expecting the fourth quarter to be poor performance. So that's what we're watching for today. And already we are seeing some signs that that is taking shape. Let me see if I can share my screen, and we'll look at the combination between the, or comparison rather, between the my favorite weekend look, the NASDAQ and the Aussie yen pair. Give me a second here, get that screen share enacted. There it is. Okay, you hopefully can see the screen that has the yes, thank you, Mike. All right, just gonna move the chat window to a place where, yes. All right, so here's what we're looking at. This is the Aussie yen, and this is the weekend. So Friday, kind of some selling, gap down to start Sunday, Monday, depending on where you are in the world. And then we start to rise, just fill the gap. Then kind of hold flat, and mostly have been holding flat. Slight deterioration through here, right? Just lower highs. Seems like Aussie yen's having a harder time getting back up to previous highs. NASDAQ, on the other hand, quietly ends Friday here, starts up, and then gets going. So this looks like through, the Sunday hours, Eastern time, that people were more optimistic. Since then, That is what has happened. And notice there's not any one big drop, right? And look how big the candles are compared to how small they're here. That is not so much a statement about volatility. That's a statement of scale. That means we're moving down rather significantly because we're covering a lot of ground on the NASDAQ futures, 15.3 to 15.1 and change. So 200-point drop on the NASDAQ. Is that right? Because if it's a 200-point drop, no, we're not quite to a 200-point drop from the high through EOL. No, I take it back. Yes, we are. We're at 200 points. Right. So that's where I was had seen the numbers before. It's about 0.6, 0.7% down, and that is that's not a huge number for pre-market, but it's more than 0.5%, which nowadays is a little larger than is typical for pre-market. When you get a bigger than usual move in the downside direction, the thing you have to figure out is this an overreaction? And people are going to say, another dip, let's buy it. US investors have been just really excited to buy any dip they can. They're getting less and less excited as the quarter has been going on. And so now the big question is, with the possibility that these pension funds mean, thanks, John. Last 7 hours, he's sell mode, just sell. And why is that, right? Because we don't see specific news events. Now, this one right here, we might have been able to tie back to a news event. But if that's the case, then that news event has sparked a long, slow burn of selling over the past 3 hours. That's enough time for bad news to go out, get absorbed, get a little transmitted, and then people to have a counter reaction to it. There's no counter reaction here. So I don't think that this is news driven. This is in anticipation of something that is coming. And, is there going to be some sort of big cataclysm? No. But there is going to be a bunch of institutional funds saying, let's lighten our load. Let's take profits where we can take them. Now, it's no big deal if one fund feels that way or 10, but if a lot of them feel that way, 50, 100, whatever, if the amount of money that they represent means much more money than usual trying to be sold, then it's going to overwhelm any amount of buy orders that are coming out. So people might look and see, oh, dip, let's buy it. But there are just too many more orders and people being represented that want to sell. So last week, I called my daughter. Here's the daughter indicator, right? If you've been following me for the past several months, you've heard of this before. Whenever I tell my daughter, hey, move your money out of the long-term stocks, because she has it in one of those, she's younger, and so this long-term retirement funds, a target date fund, they call it. And so it's usually ends up being like about 85% correlation to the NASDAQ. And so I said, move it out. And I was a little nervous that maybe I was being premature, maybe I was being overreactive in thinking that there's going to be more down than up over the next month. But this right here today and this stretch, this week, closing out the quarter is what I was looking ahead towards. And I said, move it out now, because I think even if it does go up, it's not going to go up very strong. It's likely going to go just sort of up and down, sideways. And then there's the distinct possibility that it goes down very severely. Because what happens is, if in fact this is the quarter to sell, right? If everybody's, well, let's lock in our gains, they don't do it all at once. They kind of get ready to do it. And so they start by clearing out something, whatever they have to lock in for the quarter. Then they get some cash ready so that they can be buying dips in the fourth quarter. And so when the market starts coming down, they wait. Oh, here's a good dip, let's buy this. And they start buying that. Now, if in fact, for whatever reason, conditions get so negative that when the dips get bought, it doesn't go up, but it starts turning around. Then they hold back. They say, oh, wait, this may not be a good time to buy. Let's wait for a lower dip. And then commercial traders, market makers, and floor traders and so forth, they come in and they start selling, short-term selling. And then you have people looking at their 401ks who are not like my daughter, but who are more like my age, and they're either in or closer to retirement. Wow, whatever happened there, that was a candle that really started moving south on the NASDAQ. So they start, taking their profits. They start moving their money to safety. They start moving their money over to utility stocks, something that pays a dividend, And when that snowball gets rolling, then all of a sudden you can get a really big downward move. And somewhere late in October, when this happens in the fourth quarter, late in October, that just really accelerates into a highly negative move, which is why October is the month for all of the market's worst crashes in the past 100 years because of this, fourth quarter dynamic thing. And so I'm looking ahead and realizing that if we're going to be in a state where at best we're just going to be choppy and maybe up a little bit, then we're also risking the possibility that it could drop hard over this quarter. And I'm using today's outcome as an indicator of that. How much selling did institutional investors feel like they needed to do in order to be prepared for the next quarter? Now, maybe they won't be selling. Maybe the markets will open up and they'll be buying. If today is a big up day, well, I'm going to take a referendum from that. However, let's look at this chart. This is the S&P 500. It's the daily chart. And I'm not usually very excited about chart price patterns. I mean, I watch them and I certainly know a lot about them. I read, Edwards and McGee and variations for the CMT Association. I had to read all of these kinds of pattern discussions. It was always amazing to me how ardently the proponents, the authors that I'd be reading, were just sure this pattern was the pattern. And you get some really complex patterns, Wyckoff and Gann and all sorts of stuff. But if you test the patterns, you rarely come up with anything that is persistently predictive. They all, however, make really excellent tools for doing your own risk management in a trade. Now, setting the trade up and saying, okay, here's my rules. Here's how I'm going to manage the risk of being wrong about the trade I do. Well, right now, we've got a pattern on the S&P 500, which makes it really easy to gauge our risk and sets up some very important potential opportunities. So the head and shoulders pattern, what fundamental analysts would dismissively call, the shampoo talk, whatever. The head and shoulders pattern is a reversal pattern. And really what it is a trend changing, a trend moving from up to down, because you get this movement of up, higher high, higher low, higher high, higher low, higher high, lower low, or maybe it's the same. And then the next high fails to be as high. So here we've actually got a lower low. And if this is the high where we are right now, or if that's the high, notice that they're so close, right? Then this is the lower high. If we don't get back up to that high, okay. Other people would look at this and say, oh, this is a broadening pattern. This isn't a head and shoulders. This is what's called a broadening pattern. Yeah. And the thing about a broadening pattern is what's happening is the highs and lows are getting farther and farther apart. And then at some point, either coming down from the bottom or coming or down from the top or up from the bottom, the price gets to a midway point and then reverses back to the other side. And that tells you that's the new direction of the trend. Simply because you're seeing more selling activity than buying activity. You don't know how much longer that selling activity is going to go on, but if it continues in any length, then it's going to be a tradable trend, right? So either way you look at this, broadening formation or head and shoulders top, the head and shoulders top is really just a failed new high, right? And head and shoulders can the lower line of the pattern, I've got this teal line here. This can be either sloping up or it can be level or it can be down. And usually some people say it's more efficacious for it to just be flat, that it's actually going to be better predictor than if it's flat. I take the point of view, I don't know what's a better predictor. I'm going to assume every predictor is random. It's all 50-50, right? That's what I'm going to assume. You look at it and say, well, if it's all 50-50, then why do you pay attention? Watch. Because of the relative distances that you can observe. Oops, doing that the wrong way. From the turning point, the new high, the new lower high, the relative distance between that and that. Let's make this one blue. Okay, so here's what I'm talking about. We're starting a trade here and in this vicinity. I mean, if we were starting a trade now, we're looking at the price and sort of evaluating it as a trade right here. And that number is 44.29 on the S&P 500 futures. Now, this is the day, this is the daily chart. And this is how the day is shaping up pre-market so far. We just look at that. We come up, we went up higher, but we've come down lower over the weekend. That's the action. Sellers are coming in, right? It's making a sort of bearish engulfing on that small. I mean, that's just a textbook top and reversal kind of look, right? All right, well, whatever. We're at this price right here of 44.30. The pattern's low is 43.14. So you're talking about 115 points. Yeah, 115 going down. The pattern's high is somewhere around here, right up in there, 45, let's call it 45.45. So what did we say we were? 44.30 and 45.45. That's 115. We're almost dead on in the middle of where we are. See? So in other words, that's 50-50 as of right now. And you could slide that down a little bit more. You could fudge with, what am I going to call resistance? The closes or the extremes? It doesn't really matter which one you do. You can pick either one. Just make a decision. Use it as an appropriate decision point. If you want to give it all the conservative, just like I'm not going to do it until I'm sure, right? Then you go the edge. If it's well, I want the first possible opportunity to be deciding, then you're doing the closes. So that's the only real difference. It's just your own personal preference. What kind of trade you think you're setting up. So we basically got the same distance up and the same distance down. This is a 50-50 probability trade right now, okay? What happens if the market closes down, lower today? Let's say down here. It's no longer a 50-50 probability. It is more likely that we're going to go lower than that we are going to go higher. So if I set up a trade to go to the downside right where we are now, and it moves a little bit, I'm happy about that, of course, because my trade's in the green. I'm looking profitable. I have anticipation, hope that it's going to get to wherever my target is. But then what happens next is even more important, because if on the next day it comes up here and breaks that upper side, breaks that resistance, that's what you call a failed high, failed new lower high, right? It's a pattern failure. The pattern is the head and shoulders. What this says is that it should come down, break through, and keep going lower. If at any point a head and shoulders makes a pattern failure, in this case, goes down and then comes back up, like the next day, maybe two, whatever, then right here, the probability that it is going to, it has failed. The probability that it's going to go up and make a new high at that point is typically greater than 65%. And so that's a really high probability play if you capture this move and you're going long. So what the risk management is for me here is that if I go short, I want to have a quick out. I want to have a tight stop. If I'm going to trade trying to benefit the downside, if the trade doesn't go very well right off the bat, then I want to bail out of the trade. And more importantly, I want to find a moment where I can reverse and go long, because the chances that I'm going to make a new high are very strong at that point. If, however, the chances are that I'm going to come all the way down, if I do come down here, break and close below these formerly closed lows, then there's a good chance that's going to trend lower going forward. So then look at what that means. That means I've got a trade opportunity that if I get short and I'm right, I've got to move like that ahead of me. Whereas what I'm risking being wrong is something like that. This is a risk one to make 3, 4, or 5. It's the chances that I'm going to get all of this, if I just roll the dice today and say, well, any trade where I have a little bit to be wrong, but a lot to be right, that's a low probability that I'm going to make the trade, or that the trade will work out successfully. It's a low probability. Now, if it does, it pays off big. So that's how it breaks even. Low probability of win, high payout. Put those two together. What do you got? You got equal 50-50 probabilities over time. So I'm looking at this, I'm thinking, yeah, I know it's a low probability, but I don't think it is as low as is typical. So in other words, if somebody walks up to you and says, I got a bet for you, I'm going to flip this coin, and if I can flip it twice in a row the same, either heads twice or tails twice, right? If I can flip it twice in a row the same, then I'll pay you $2. I'm sorry, I'm saying it backwards. If I can flip it twice in a row the same, then you pay me $2. If I can't, then I'll pay you $1, right? Well, you think about that bet and you realize, in order for them, if it's truly fair, if you trust them, if it's not a loaded coin or something, right? If it's truly fair and you're thinking, this dude's just a little drunk, I'm going to take this bet. You're trying to figure out how to do this. You're going to run the probabilities. 50-50, multiply twice, quarter. It's 25% probability that somebody can flip heads twice in a row. So you realize with the 25% probability, that means there's a 75% probability that it won't happen. And he's saying, if he does it, I'll have to pay him $2. But if he can't do it, he'll pay me $1. Well, on the first flip, it might sound like, well, you're gonna get better than I am because you're getting $2 and $1. No, over 4, 5, 10, however many flips, If you can say, I'll take the bet as long as we try it 10 times, then you've got a winner. Again, assuming he's not trying to pull a fast one by cheating the flip. Somebody else picks the coin, somebody else does the flip, right? Whatever. So then you would take this bet all the time. You take it every time for 10 times, because over 10 times should pay out for you. You have a 75% chance to get 1, and he has a 25% chance to get 2, which means 3 out of 4 times you're going to win, right? The odds are stacked in your favor. Now let's switch it around. What if you play the game 10 times and you say to the guy, well, gee whiz, I ended up with more money than you did. He's like, yeah, I know, it should have worked out in my favor. Why didn't it? Well, because he doesn't understand stats. So, all right, tell you what you need is more payout. So let's do it the other way around. How about if I flip 2 flips in a row, you give me $4, and if I flip if I fail to flip twice in a row, I'll give you $1. And he says, well, I just watched you win this bet, so sure, I'm going to take it because I know that failing double flips happens more often. Of course, he would be making a bad decision, because the $4 payout means even though you're going to have a losing streak, even though you're going to fail a lot, when you do fail, you're going to win, right? So the 3-to-1 payout is break even. A 4-to-1 payout would mean, hey, I'm going to take the low probability side, because I know that even if I win 25% of the time, my payout is bigger than 3-to-1, right? Well, what if we were to do something like this? What if you were to say, I somehow know that the way he flips creates double heads more often, right? So it's not a matter of 3-to-1. It's somehow a matter of 1.5-to-1. It's a 40% flip instead of a 30 or a 25%, something like that. Anyway, I'm making this too convoluted. What I'm trying to say is, if you have slightly better odds than normal, you want to take it. So I'm looking at this and I'm thinking 50-50 odds. This is probably not a 50-50 odds trade. It's probably the case because we've already come down. Look at the growing size, of those candles. See how they've been small, 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 but when they go down, they get big. Every time they get big. And this time they got big, and then they got bigger, right? That's like more and more and more anxiety over prices. This is, people buy the dip enthusiastically. People buy the dip enthusiastically. People bought the dip, but not as enthusiastically. Now they bought the dip a little more enthusiastically, but the best they could do is to get here. See, I feel like instead of a 50-50, you've got something like, a little more than 50, maybe 55% that we're going to head to the downside. And more important here, I don't have to go, wait all the way to here. I just have to wait to this. So all I need is this thing to be a probability of better than 25% that it's going down here. And I think I've got a 55% probability. So this is a bet I want to take. This is something I want to do often if I feel like, hey, buyers are not going to be in here. That's what I'm going to watch really closely today. And if after today we do close to the downside, then I'm going to feel a lot more comfortable, risking this much to make potentially that much. Now, I'm not going to wait until the end of the day. If in fact we get going and we, because I know that we could have a day like this. We have this huge down day. And then from here, all of a sudden, it's not this 50-50 pattern going forward. I want to be in early on this, because if I am wrong, it's just up to there that I get out. But I also want to see the markets open and some selling start somewhere in the first, half an hour. I want to see more selling than buying. If right out of the gate, the first 5-10 minutes, I see that, then I would also be interested in making an entry to the trade. So I spent 30 minutes trying to explain to you why I think the setup is good. There's all sorts of reasons that I think should nudge it to the downside, both in terms of price behavior, point where we are in the calendar, and the weekend futures. Okay, so we're getting a little bit of a rebound here the past 10 minutes, but you know, not wiping that out, right? We're still just down. We're going to keep an eye on it for the next 30 minutes and see how we go. But all of these things together make me feel like we've got a sort of momentum and trend, price trend behavior going on. We've got the pattern that sets up my risk reward. And so comparing to the risk reward, I feel that the odds are favorable for me for this setup. For those two reasons, I like the idea of going short rather than going long. So what is it that I'm going to look at in order to benefit from going, making a trade where I go short? Let's see which chart we want. This got my Keltner channels on it, so yeah, we'll look at this. Oh, I didn't update the nicer, newer looking ones we did over the weekend, but you'll still get that in. In fact, I've got, let's see, the 1 band, 2 band, 3 band. Yeah, no, that's still the same. 1, 2, 3, and 4. Yeah, I don't know. Somehow this looks like I have an extra set of lines, but I don't. No, they're just 4. Okay. So where are we with that? So we noticed that we didn't stop at 3 band. We didn't quite make a 4 band touch on SPY, and we did have that rebound, right? So the big question is, are we going to, cross that middle line and head up, or that's it? That's all the rebound we're going to get, and we're going to, start heading lower from here. I like the 3 band where, it crosses the 3 band, it comes back up, just where it touches into it and comes back up. This one, I mean, over 2 days, you could say it did. It dropped, went way down, and then came back up. Okay, maybe that's all right, but for all the other reasons, I'm discounting this 3 band trade. So, oh yeah, the shorts, SPXS. Okay, this is what this is the stock that if the S&P 500 goes down 1%, this goes up 3%. I mean, there are some others, but this is the most heavily traded one. So if you're trying to capture just a downward move over the next week or 2 or 3 or whatever, this is an excellent one. It's a terrible, terrible investment. It just loses value like an option decays away in time. So don't get in here and expect to, stay for a while. Get in and target 1 to 4 weeks. 4 weeks would be amazing. If this trade just kept going for 4 weeks, you'd have a wonderful trade. But you're going to expect more, like you're going to get profit out of a week or 2 worth of move. In this case, we're going to look for the possibility of going, from here. Let's say the markets have a 5% retracement. That would equate to a 15% move here. So 15% move from 21, that's going to be $3. So you're actually looking to go right back to there, $23, $24. So a 5% retracement would be kind of big. We haven't seen a 5%, pullback on S&P 500 or the NASDAQ for a while, and a 10% would be huge, right? So 10%, you'd have a really nice move on this coming way up to there. It'd be a 30% gain on SPXS. So it would probably take 3 weeks for that to play out. So that's your kind of outlier, big, amazing trade. And of course, then there's bear market move. You're going to move down 20% or something. Then this thing, goes fabulous, right? Those are very, very outlier possibilities. But if they come, they're going to start right here with, you know, 3%, 5%, 10%, just keep growing. And they're not going to go all in one direction. They're going to, you know, work their way into that. And so, anyway, this is the starting point. If in fact there were to be a big move, now would be the time you'd want to get in on it. And so the other one to look at would be, whoops, I didn't type enough. SQQQ. Oh, too many that time. I've got the chat window covering up. That's a high key. All right, there we go. SQQQ. If you like low price shares, you're gonna love SQQQ right now at $7, right? And when you look at a chart like this, you think, oh wow, it could get from 7 to 30. No, it can't. It's just, think of it in terms of NASDAQ drops 1%, this thing goes up 3%. And so NASDAQ drops 10%, it's going to give you 30% return. So 30% return on 750, you know, that's going to be what? 60 cents, is that? 10% is 70, so $2.10. So you're going to be up at 9, you know, so a 10% drop in the markets would put this thing just to right about here. So it's important to keep your expectations appropriate for these triples. That's why I do what I do when I look at this. Like, okay, how do I know how good is good, right? Well, I'm going to be watching the stock, the downward, you know, move of the index, the stock indexes. And if I look at that and say, oh, it's going to turn around, I don't care what the price is here. I'm just going to take it, just take the profit. But meanwhile, while I'm looking at the chart itself, I want to know what's realistic. What's realistic is the old high, because if we take out the old low on the index, we're going to take out the old high on this. And then what's optimistic? Well, what's optimistic is what I was talking about up there, right? So somewhere between realistic and optimistic is where I would expect this trade to be done. Okay, if that's what's the potential target, what is my risk? Well, that's pretty simple. It's just right there, about 757. Maybe I could even go 750. That's being a little generous, perhaps. But for round numbers, let's say it's 750. And then where am I getting in? Well, this thing may gap down, and so I might be getting in at you know, right around here, 790, something like that. So fine, I'm going to risk 40 cents on this one side, and I'm looking at, you know, potential of 50 cents to $1.50 somewhere in there. So it's that's the trade setup. Now I wouldn't have to come all the way down to 750. I literally could just come to here, 765 even. If we make it all the way back to this area, then that's a lot of buying. The weekend selling that we're watching right now is getting wiped out by enthusiastic buying, and that's probably, you know, you don't need to wait, just kill the trade. But anyway, those are just how you can reduce the risk size thing. All right, now a couple other trades that aren't, you know, just trying to play the US market going down and going short. Well, sorry, no, before I leave this trade, I've got to talk about this a bit more. Here's why this is such a good trade. Number one, it could be that all SPXS, SQQQ, and the other one is TZA. Now that's the Russell 2000. If the big indexes are going to go down, the Russell's going to go down more. TZA, you know, if in other words, if the Nasdaq drops 1%, the Russell might drop 2%. If this TZA, if the Russell drops 2%, TZA goes up by 3% or by 6%. Sorry, it's a triple, just like the other two. It's just that the Russell has bigger moves, so this one is capable of throwing off bigger moves to you. TZA. So all three of these. The reason these are such good trades right now is not that they're for sure going to work. I think there's a little statistical edge that they're going to work, and so I think systemically it's a good attempt. It's something that you want to try. But What I love about these trades, in addition to all that, is I love knowing when I'm wrong on these trades. When these trades are wrong, they are a fabulous entry signal for going long. So it's like, how could I get in this market right now? How could I buy that thing? That looks terrible to be a buyer of. That looks like it's just poised to fall off the next cliff. But I could always be wrong. What's the first moment I'm going to know I'm wrong? Well, it's going to be if I take this trade and then I get all bummed out because I lose it, right? The minute I feel like, oh, this is a losing trade, that's my cue. That's my emotional cue to say, hey, go look at the long, because the long is probably there. As I mentioned before, a failed head and shoulders is probably, like I said, most patterns are just 50-50, but a failed head and shoulders is not 50-50. If you come down and then buying wipes this out, then all of a sudden you have a better than 50-50 chance over a specific distance. Really, really good pattern to be looking for. And how do I know that's true? Well, I did a little bit of back testing and found that out. But there's some simple logic that tells it to you. It goes like this. Most market action, price action on a month-by-month basis is bullish for the S&P 500. U.S. stocks, I mean, look over the past 100 years, they go up. Yeah, there's these big, right? But on any given month, it's not a 50-50 that it's going higher. It is a 58% chance that it will go higher. And some people would say, that's a good reason to be buying U.S. stocks always. You should never buy anything but U.S. stocks. If it's, you have 58% chance it's going to go up next month, right? Yeah, that sounds good. And it is good if all you're talking about is up or down, right? The problem is that when it goes up smaller, and when it goes down bigger. You're looking at it right here, right? Small candles on the way up, big candles on the way down. It's not usually so obvious and dramatic as it has been over the past couple of months, but on a general trend, that is the way it goes. Some people say the bull goes up the stairs and the bear jumps out the window. I mean, it's all that same. There's lots of variations of that little quip, but it's this idea that when people sell, they're in a hurry to sell, or they just really have to sell. And I don't know, I got to sell today, so I'll take that lower price. But whereas if they're buying, see what happens is if you have a lot to buy, here's how it goes. If you have a lot of cash and you got to put it all in the markets, you buy and you buy and you buy until all of a sudden all your cash is in. And then what do you do if you if the market keeps going up? Nothing. All of your cash is activated. You sit and it goes up little by little. On the other side, you never just sell everything, at least these large funds. They don't just sell everything, right? What they do instead is they start selling. Oh, I've got to sell some more. And I've got to sell some more. And the more it comes down, the more and more and more they sell until they don't have any more to sell. And then that's when the market kind of, big bad bear market, right? But the thing is, if you buy and the price keeps going up, as an institutional buyer, what is your response? Nothing. Sit on it. You don't do more. On the other hand, if you sell and it goes down, what's your response? Sell more, right? So you see the difference. Buying makes you do less activity. Selling makes you do more activity. Yet another reason why you get more volatility on the downside than you get on the upside, right? So 58% chance doesn't mean that you're going to have equal gains. You will go up, but you won't go up as much as if when you go down. So that's why the markets are equalized in their opportunity, because if they weren't, then everybody would just buy and buy, and it would just run it up until an opportunity was, statistically removed. If there was an 8% edge just for being a buyer any given month on the S&P 500 stocks, then no fund manager would ever do anything else. So that being said, we can know that the market has about a 58% probability month to month. Annual, year to year, it's about a 65% chance that it will close higher at the end of the year than it will end lower. So, the probability that we're going to go higher is built in. You have a 58% chance that it's going to go up next month. So that's regardless of whether the pattern. But if the pattern breaks, then people see the pattern, see, oh, whoa, we didn't make a new low, right? And so you attract a little feedback. That gives you another 2%. You're at 60, right? And then after all of that, you just have the fact that we're going down, then we didn't collapse and we're going up. And so when you start going up, you start with a bigger candle, and then where you are in the pattern has a higher probability because you're closer to the top. So all of those things put together, you have something like a 65% chance of making a brand new high. Now, just because you make a new high doesn't mean it's going to go rip roaring higher. But at that point, it's all gravy. You don't care. You're just talking about getting back to the new high. So anyway, long explanation for why this thing has a higher probability, but that higher probability then sets up this beautiful risk management scenario. If in fact it fails, then we want to be looking for opportunities to buy. I don't think earnings this time around is going to be. Let's look at the pre-market trading, see what's happening. Which stocks are showing unusual activity. Most active, RCAT, NAKD. Yes. I want to see the ones that are the highest market cap. Look at that. What is the stock that has the highest market cap, but is also among the most active? The answer is SQQQ. Guess what? There's people out there doing this trade already, even before the market opens, because they're seeing what we're seeing. But right behind it is QQQ, and that is not so much a function of see that is interesting. QQQ is just super heavily traded, so before pre-market. But what I think is fun to notice is QQQ, super heavy stock. Its short is trading 3 times as much as, well, not quite, 2.5 times as much as its regular ETF and index fund is trading just in the pre-market. So yeah. I don't see a lot of large market caps here. 600 million. So these are all kind of small companies. How about the ones making the biggest gain? Vizio. Okay, that could be good. Oh, you know what this is all about? This is about Black Friday. Vizio is the people that make the TVs that everybody charges into Walmart to buy. So this is a retail. It's fourth quarter. It's Black Friday shopping in the U.S. is November, the Friday after Thanksgiving, and there's all these sales. Well, that's coming early and earlier because people online don't wait for that one given day. They just start shopping all through November. Vizio's, maybe they got earnings. I don't know, whatever it is. But let's have a look at Vizio. If you like the idea of trying to find something to buy long, this might be one worth looking at. So where's Vizio? 1950, but in the pre-market, what's it doing? It's up. How much? 8%? No, there it is. So 21.15. So 1955 it closed, and it's looking at 21.15, way up in here. So it's breaking through all of its old highs. Yeah, that's a pretty strong signal. I mean, interesting, right? So Vizio moves around a bit. Is this? Oh wow, It's only been around this long. That's interesting. Been up at 28. We're closer to the low right now since the IPO, but now we're going to jump up to here to open. And it's not because of earnings, interestingly enough. Yeah. If I wanted to do a long, this would probably be the one that I'd be after today, would be VZAO. Because it's probably not going to be heavily correlated. Since it's an IPO, there's not a lot of institutional funds in it. There's, I mean, there's some, but they're not trading it. They're not like, oh, we got to take our profits. Are you kidding? No, they're going to sit. They're going to hold. If any institution bought Vizio, they're already just going to hold. If individual traders are buying it, well, they're done selling it because we come down here and we're getting tiny days. We have big days through here, tiny days here. Interesting, huh? Which means that people aren't panicking and worried about this company's prospects. Now they're buying it up over the weekend because of some reason. I think that's a pretty good chance that we're going to entertain this type of move. So I like VZIO as a potential. I don't know if it's liquidly traded though. That's something. Let's get the volume on there. Sorry, I messed with my chat window again. Okay. So what are we looking at for volume? 380. An average in there is about 500K. Yeah, it's close enough to a threshold. I wouldn't trade options on it. And I might have to accept, a larger bid ask spread. Just be aware that that's the case. But I still like the idea. And so I'm going to watch to see if it does start up but comes back. That's fantastic because then I'll get to bargain shop it. And then maybe later in the session, I would get to. Yeah, looks like I have cleared out everything in the paper trade. Because it's going to be a whole week, I'm going to go ahead and put on the trades. I'm going to look at this real quick. What is my, yeah, see, all right, there we go. We came up, we saw back down. We're still bouncing right now, right where we are. You've got people feeling like it's equilibrium. I'm interested that the Aussie yen hasn't tanked. It's not going down a lot either, which means that what is going on here really is US based fund managers, because globally they don't care. Why don't they care? Because they're not attached to the quarters. They're just globally the currency markets. That's just year-round money, right? But here in the States, quarterly for the stocks, quarterly makes a big difference. So that's going to be my explanation for why we don't see the Aussie yen falling off. That being said, the mere fact that the NASDAQ is pushing down so heavy means that when it gets opening, when the Aussie yen, when the NASDAQ market opens, it's probably going to push the Aussie yen lower. And so the higher and higher the Aussie yen gets, the better and better the setup is for it to drop. Maybe not immediately, but within a few minutes. Now, if the Aussie yen just keeps going higher, that could be a weird situation where one goes higher and one goes lower. I mean, anything can happen. I don't want to, but these are correlated 75% of the time. The idea that they're going to go to that they're going to diverge, that's flipping heads twice in a row. The more frequent bet is that they're going to converge, that they're going to follow each other around. So if the NASDAQ is going down and is persistently pushing down, then you would expect to see the Aussie yen do the same. If it doesn't, if the Aussie yen keeps going up, then watch the NASDAQ. Maybe the NASDAQ's going to reverse and go up, right? Anyway, that's a trade setup you can get. While we're at it, let's have a look at the US dollar Japanese yen. Yeah. See, this is interesting, don't you think? Because the dollar, well, no, that makes sense. The dollar getting stronger against the yen. Dollar's going to get stronger if stocks get weaker because money's coming out of stocks and moving into cash. So when selling, when you get an impetus of large selling happening, then you tend to get the dollar moving up. There's another reason the dollar is moving up, and that is the anticipation that interest rates are going to be raised. Not anytime soon, but eventually. And where every other currency in the world is not interested in raising rates, even the hint that the US dollar might raise rates is going to attract money towards it. So I guess it does make sense. The idea, though, that the yen is weakening, if the dollar is increasing, then the yen is weakening, right? If the yen is weakening, that's also going to prop up the Aussie yen. See what I mean? So that is beginning to make sense to me. Why we're looking at, because the Aussie yen and the US yen should also kind of be moving close. But if at this moment you get the idea that, hey, a lot of people want US dollars and they want to pull their money out of yen into dollars, and therefore the yen is going to weaken, that's going to make the Aussie yen strengthen also. And so all of this happening right now would tend to make sense because it's the beginning of a moment where people are going to start demanding cash in the way of US dollars. We are 3 minutes away or less from the US market opening. Let's see if I can bring up my Thinkorswim account so that we could watch the fun in real time, or in a better real time than the TradingView charts would give us. Well, hopefully the updates will get installed. We got these little, oh, there it is. Okay. That too. Hey guys, now's your time to be geniuses. Chime in. What do you think? What are we going to see? Will the markets open and drop, or will they drop a little and then rebound? I'm very curious to hear what you guys think might be happening, just for fun. Stuart, hey, did good to see you, Stuart. Did you like the class over the weekend? I didn't get a lot of feedback from you, and so I was thinking that maybe you had to step away a bit, but whatever. I am curious just to know whether or not you liked it. But I like what I'm hearing, pop up a bit and then head lower. Yeah, went to bed early. Okay, good. Well, I hope you got a chance to record it or have access to the recording. Drop and bounce back up is what Paresh is feeling. John's feeling up a little, then drop some more. Okay. Let's see. Those are the NASDAQ futures right there. We're going to zoom in on them. We're just a few seconds away from this. Okay. By the way, did anybody tell you about a recording where you could get the link for the recording for the class we did over the weekend? For those that attended, I want to be able to send them the link. All right. Just a few seconds away. What do we do? About 20 seconds away here. So the fact that, we hit this low and then bounced up from this low tells us that this price level right here is probably meaningful to somebody somewhere. And the fact that this was the extreme means that that level is meaningful also. So we want to see how price reacts at those levels. All right, there it was, first touch, we hit that and the buyers came in. See, that's interesting, that level was oops, I got that activate. Can I do that? Yes, I want to make that level. Okay, buyers straight out the gate. So people saw, hey, it's a dip, let's buy it, and they showed up to buy. Sweet, thank you. Sweet's out there. I have access to recording, but James is the one to reach out to about the thing. Sorry. Okay, good. All right, I'll get with James. You do have access to the recording. I will probably be asking you for a link to the recording later on today once I can get that connected with James. A healthy correction, NASDAQ will be a good retest, 14,850 bounce up. So if we see it drop to 14,850, yeah, heading down to that level and then retrace from up there. We have time. One of Monday's shows would be nice to walk over the gap trading live if possible, please. Okay, yes, on a day that I don't think is going to be nothing but selling, right? But hey, the Vizio trade would be good to have done that today. I don't think I think we're going to see more selling. So far, first 5 minutes don't they're not making me look genius because I've been saying selling's coming and this is mostly buying. Buying is tepid. Interesting here that we're finding resistance. If we get past this, that could be meaningful. If we're interested in going long. Okay, we pushed past it a little right there. So that means there were more buyers in the pre-market than there were, or in the open market than there were at the pre-market, but not by much. Interesting that right as soon as we ticked those, in came the sellers. So we had another 3 minutes before we see where that candle finishes off. But let's get ready to yeah, the mad half hour. John, wait to see what it's like after 30 minutes. That's right. However, I would say that if we see this candle drop and break and close below this line, certainly if we see it drop and close below that line, that would be interesting. I mean, that's going to be enough for me to do SQQQ. Okay, we're definitely past that line. We haven't closed it, but we pushed past it. So I'm going to get my paper trades set up. I'm going to leave that there so we keep watching it, but then I'll bring this screen over to show the order that I have set up for. I think I'll go SQQQ. I kind of want to go TZA. Maybe I'll do them both. But I want to start with SQQQ. So I'm going to get this order set up on SQQQ. SQQQ is trading at 787. And we're heading down there. Yeah, I'm going to buy this thing. 788. And I'm going to set up stop loss of 750. So that's going to be 39.40 cents or so. And then the take profit, I'm actually not going to put a take profit. I'm going to let that one run. And then my risk at 1% on a supposedly $230,000 account is going to be about 6,000 shares. I'm going to go ahead and bump that up to 6,000 shares. Now, if I were doing this outside of paper trading, I would probably come at it 1,000 shares at a time. But because I've got 6,000, I'm probably going to have to pay an extra penny. All right, so I went ahead and I added that trade, and it executed at 789. So I'll bring that over and show you. This is the trade setup I made on SQQQ. In at 789, stop loss at 750. And I'm interested in just taking profit up there around 850 if in fact the market does go down strongly like we're anticipating it would. So there it was. First 5 minutes, I feel very vindicated. We came in, some people said, buy the dip, it's a dip, right? But more sellers. See, that was the narrative I was crafting to explain what we might see. We did see buyers jump in, but sellers overwhelmed them. And so it's possible that those sellers overwhelmed because of the day it is, because of what it was I was talking about, where people, institutional funds, are looking at taking profit or taking their first 3 quarters profits today to try to lock in some of their gains before the quarter ends. And to do that, they have to have those orders processed today. We're down 1.2% already on the NASDAQ. How much lower will we close by the end of the day? Very possible that we will drop a whole nother percent lower if the scenario I'm describing takes place. If it does, that'll leave a big ugly candle, big ugly red candle on the NASDAQ chart and S&P 500 chart. That head and shoulders, will be the new lower high. It's going to attract more attention to the sellers. And then we will see if in the next 3 days, retailers and commercial floor traders decide to pile in. 14,184, missing it, John. What's 14? Oh, will it get there? Will it get to 1484? Let me bring back my NASDAQ. Actually, I'm going to bring it back this way here. And we'll go look at NQ. All right. So 14,184, clear down here. Am I misunderstanding you? Are you talking about the possibility of moving there? Oh, I see. Sure. This is the head and shoulders pattern that would move, that the NASDAQ could follow. And so if you were here, then what you do is you predict that much of a move. 14,184. Yeah, absolutely. It could. I mean, what's more likely, or what is highly likely, I think, is that if this thing ends here or lower, especially if we go down 1% today, then we're at least going to go to break. We're going to break that low and at least come and retest that low. If we break through that low, then yeah, we could easily end up down there, but it might take a couple of months before we get there. Okay. So if we did go from there to, why isn't that drawing? Come on. If we did, make that move all that way down, it wouldn't be just that quick. It would probably be, well, I don't know. It's hard to say, because if I will say this, guys, before we quit it. See how big those candles got? That's how much the price acceleration, the drop in price accelerated. And notice that the move here, going back from this level, right? This was long and slow. This got shorter. Hey, if we come down and hit this line, that's even shorter still. Like the time period is compressing. I've seen this before when time period compresses and these candles get bigger faster, that the down move, if it breaks, really moves fast, really big, bad, ugly. So could it get down there under those circumstances? Yes, it could. It really could. I think it's more likely, though, that because this is just the end of the quarter, it's not people piling in and saying we're out of here, right? That we're going to see a big move, then we're going to see, who knows what happens. I think kind of smaller days. And then we'll have to pay attention to, because they might even bounce back up, but they won't hit the new high. So then we pay attention to October 1st, because if October 1st is a big sell-off, that means the institutional guys said, this quarter is going to be a bad quarter. I got to really load or increase my cash and play it safe. And if that happens, then yeah, we're going to see not only 14.1, we're probably going to challenge 13.50 if we see a big bad move. So big move on the 4-hour down so far. Yeah. Well, let's have a look at what the Aussie yen is doing. Is the Aussie yen starting to follow? Oh, looks like the Nasdaq's being a buyer, right? Oh, no, that's just the lag. But see how the Aussie yen has topped, and we're selling. That's so Nasdaq is not working its way back to, yeah, that's still the Nasdaq. We're just 15 minutes behind there. Okay. So what's going on is we're already breaking and going lower, and Aussie yen is coming with us. So I just think everything's in place for a continued down move, and why I recommended the short ETFs as the trade for today. Somewhere in the middle of the week, if that bounces and you find some support and you think they're coming back up, check out Vizio at that point. Or in fact, what's Vizio doing now? Let's find out if it's correlated. VZIO. Are we seeing 3 down candles right out of the gate on Vizio? So we saw the first candle was down, but the second one is buying. People want to buy this stock. See that? We're watching the Nasdaq go down, but this thing, buyers are here. So it's not highly correlated with the Nasdaq. So if you just really want to buy something, that's the one. All right, everybody, we're going to see how things shake out for the next week, because the next week, if in fact we just sort of come down today and then sort of stay there, the next week could be another big down move. And it could be part 2 of what we have been talking about. If it's not, however, that would be a fantastic time to be looking around for which stock to buy. See what I did there? All right. Till then, take care and trade well.